Okay, welcome to Unit 3.3, Evaluation of Inventories. Now, you heard about inventories previously in other modules, but it cannot be argued. Inventory itself is a cost of ownership. It's almost an accepted cost of ownership. Not where you're taking a loss and you have to go bankrupt, but you have product, and that product essentially becomes your inventory. If you have a large inventory, that means your sales are going up. But nonetheless, they have to be tracked and monitored, and there's different methodologies that go into that. Also some important terminology. Whereas Module 3 is 30 to 40% of your final CLEP exam. No one unit or module is more important than the other, but because of the size of this particular module, I want you to pay close attention to some terminology, for instance, like you have before, and especially in Unit 3.3, as it pertains to certain exam questions. Okay, so inventory valuation, that's what we're talking about here. What is it? It's the actual dollar amount that's associated with items contained in a company's inventory. So how much is each individual one worth, and how much is it worth together? Total inventory. But we also have to account for each individual dollar amount as well, depending on the type of product you sell. If I sell a roof for a house and I make commission on that roof, well, I may only sell one roof a week. Now, that's not necessarily great, but it's still a product. It's a service, there's labor involved, but there's still a product. You need product, pieces of the roof. Furthermore, the cost of items defined as all the costs necessary to get the inventory items in place and ready for sale. Okay? So let's remember, the cost of items defined, okay, as all the costs necessary to get the inventory items in place and ready for sale. Very important. Now, inventory evaluation will include the costs of, here you go, production. What does it cost to produce what you're selling? That will vary depending on the size of your business or the product itself. Materials. What are you using to sell a product? Are you using titanium steel? Are you using wood? Are you using plastic? All of those types of chemicals and resources, they all vary in price. Nonetheless, must be monitored. Labor. What are you paying in labor? Are you paying somebody heavy money to install a large type of product? Or is it something that could just be delivered, dropped off in a package? That makes a big deal. And you also have the labor of creating the product that you're selling. You have people that actually put together the materials as well. And overhead. Overhead could be other things, such as the lease on your facility, trucks that you have, all different types of things to deliver and make sure the business is in motion as an entity, operating properly. Okay, now we have some methods to track inventory. Okay, first method, the periodic inventory method. What does this do? This keeps track of merchandise costs in various purchases. Then it computes the costs of goods sold on that income statement. Fairly traditional method. Then we have the perpetual inventory method. The perpetual inventory method increases the inventory account with every purchase and lowers the inventory account with every sale. So we have an increase and a decrease with every purchase. Days in inventory. Days in inventory measures the average number of days before the merchandise sells. Days prior to sale. That's important because it allows us to project. For the future. Inventory turnover. Inventory turnover measures the number of times inventory completely sells per year. Sales out 1 year. That means all your product is gone and you have to reinvest in inventory. That's actually a good thing. That means everything else went up for profits. Now, a couple other methods I want to mention as it pertains to your exam. One's called FIFO, F-I-F-O. FIFO is an accounting method that stands for first in, first out. What does that mean? Well, this method measures the cost of inventory on a balance sheet and represents the inventory that was most recently purchased. You may see that again. Furthermore, it takes the oldest items and records their sales first. However, there's a caveat to that. You're recording the oldest items as sold first. Well, you're kind of flipping the script a little bit because they may not have been sold at all. So you may have something in your warehouse, types of inventory that are literally on the shelf, never been sold. There's nothing you can do about it. Nonetheless, the oldest items get recorded first, even if they're not sold. But remember, with FIFO, first in, first out, the cost of inventory on a balance sheet represents the inventory most recently purchased. Then we have the opposite of FIFO, and that's LIFO, L-I-F-O, last in, first out. This articulates the most recently produced items are recorded as sold first, not the oldest, just the complete opposite of FIFO. That's all you need to know. The most recently produced items recorded sold first. Now, here's another thing you need to know. LIFO, for multiple reasons, is allowed in the United States, and it's GAAP approved. Outside the United States, it's actually banned. LIFO is not allowed to be used outside the United States. So, if you're a business and you do international operations and you are accustomed to using LIFO, when you do sales or business itself outside the country, or if you have satellite offices with inventory in them, beyond a shadow of a doubt, you will have to change or alter your methods. That's why a lot of businesses now only use one type of method so it doesn't confuse their accountants and themselves. Because you have owners and investors, nobody wants to get frustrated, especially people that are actually documenting this stuff. Okay, there you go for 3.3, valuation of inventory.